Welcome back to Morning Trade Live. It's time to go inside out on Tesla, a name people loved. They loved Elon Musk, his vision, everything about Tesla. And then they had this stock down 50% off its highs and ran into the politics of it all as well. Garrett Nelson, Vice President, Senior Equity Analyst at CFRA Research, is with us now. What are your thoughts on Tesla today, and how different are they from a short time ago?
Sure. Thanks for having me. No question, it's been a wild ride in Tesla over the last 6 months. But you look at where the stock is trading right now, essentially back to where it was just prior to the election in mid-October. But the stock more than doubled. Um, from where it was, it peaked at almost $480 and is back down to roughly $230. So um, if you look, I've just been reminding clients and investors that volatility has been the rule, not the exception with this stock for several years now. In fact, what we're seeing right now, this is the eighth time since 2019 that the stock has declined, had a peak to trough decline of 40% or more. And so I think that's what we're seeing right now. When we look at the risk reward here, we actually like it. We think a lot of the negative sentiment is priced in at these levels. While we could see more downside in the near term, we think downside is fairly limited. And then looking out, over a 12-month time horizon, which is the basis of our price target, we actually see the stock materially higher than it is today.
So at this price target, we have 230.96 today. Where can this be in 12 months, in 24 months?
Yeah, our 12-month price target right now is $360, and we just took that price target down last week. We took our estimates down. Obviously, their sales are going to be impacted with Elon Musk political involvement, the very public backlash, boycotts that we've seen from consumers. But it's not all negative. There have been some new customers that have been coming in. Some new sales, and we actually think the first quarter was the low point, the trough of their quarterly sales for the year, and things will be improving from here. Q1 is typically weakest for auto manufacturers in terms of sales, and Tesla had all four of their factories had downtime in the first quarter as they were retooling production lines. As they prepare to bring the new Model Y to market. So that really had a detrimental impact on their first quarter volumes, and we think things are going to improve somewhat in Q2 and beyond.
Yeah, I mean, when we think of Tesla, we shouldn't be thinking of it as a car company, right? It's so much more. When we think of robots, robotaxis, charging, so much more, right?
That's right. And, I think, there's aspects of this story that we like here. Their energy storage segment, which is now a higher margin segment than the auto business, they continue to grow that business at a very strong rate. You had the second highest energy deployments in the first quarter. And also, we think a really underappreciated aspect of the story here is that they have so much less exposure to tariffs than other automakers. So we view it as a chance to really pick up market share. They have a very strong investment grade balance sheet with $36 billion of cash. They have the highest gross margins in the industry. So we actually think they're well positioned, better positioned than some of the other automakers to weather these tariffs.
And Tesla obviously does a lot of manufacturing here at home. Rivian does as well. But Tesla at 231, you think they're well positioned because of the tariffs situation for some of the other automakers. I was just talking about a couple of sell ratings on GM and Ford. The tariff story, you said they can probably gain market share. Where would that be?
Yeah, I mean, it would be in the U.S. You look, last year was the first year in which their sales actually declined year over year in a decade. So we think, the worst of the impacts on their sales have been seen, and we think it's in the rearview mirror. So we're looking at a much more severe impact on sales for especially the Detroit 3 automakers. As you noted, there have been some factories that have been idled, and those other automakers have much greater exposure to non-U.S. markets. Tesla has been named the most American car company each of the last 3 years, according to a study by Cars.com. So I'm not saying that they're not immune to tariffs. They will be impacted, but relative to other automakers, they're in a better position right now.
Yeah, and just quickly, other buys or sells that we should note? I always like to give the viewers all of your knowledge, or at least a part of your knowledge, I should say.
We're largely neutral or negative on the auto space. So we have sells on Rivian, a sell on Lucid, and we have holds on the Detroit 3, all three of them. So, this is a space obviously highly cyclical. You see what's going on with the market, and the stocks have really, been walloped, over the last couple weeks with this drop in the stock market. So, performing kind of as expected in light of the macro. So, some of the ideas that we like, actually looking beyond the consumer discretionary space into consumer staples. Constellation Brands reporting after the bell tonight. We have a buy on. And consumer staples has been the best performing sector so far this year. So, we've taken a bit of a more defensive approach in terms of our recommendations and the sectors that we like here. But that's one name, ticker STZ, in the beverage space that we like, in addition to PepsiCo and a couple others.
All right. Thank you. I wrote them all down, Garrett. I appreciate it. And pretty exciting for the folks who do like Tesla because they saw it at 488. They may be having a hard time seeing it at 230. But if you think it's headed to 360, though that's a lowered target, I think they'll take it. I mean, maybe they could double down, pick up more here, and then see that gain. Garrett Nelson, CFRA Research. Thank you. Let's trade it now. Tom White, host of Fast Market, is here. Good morning to you, Tom. We've had so much to digest already this morning. You're looking at Tesla, and you have a trade for us.
Yeah, I got a couple. The first one I'm going to take a look at here, Nicole, is a little bit more conservative. I think in this stock, every time you trade it, you should be risk-defying, but even more so now with all the headline risk that's out there, all the higher implied volatility. We've got IV percentile rank in Tesla about the 97% level. So we're in the top 3% as far as implied volatility levels that we've seen over the last 52 weeks. So that gives you some opportunities. First strategy I'm going to take a look at here on the pullback that we've seen over the last 3 or 4 months here since hitting those all-time highs in December is a short put vertical that's neutral to bullish, where you can profit in 3 out of 4 scenarios, take advantage of that higher implied volatility, but also knowing exactly what your downside risk is on a position like this. So they report earnings on the 22nd of April. I want to completely avoid that event because anything can happen in those type of earnings events and what can happen to the stock afterwards. So went out to the April 17th monthly options that expire in just 8 days. Really short-term positioning here, where I'm going to go sell the 210 strike put and then against it because I want to stay risk-defined. Buy the 200 strike put, short neutral to bullish, $10 wide put vertical. You're going to collect roughly about a $250 credit. That's what you can make. $2.50 or $250 per spread with $750 in risk, but that's all the way below $200 a share. Now, if you collect $250 on this type of strategy, takes your break even down to $207.50 over the next week. That's over 8% below the current share price in Tesla. So you profit in 3 out of 4 scenarios here where stock goes higher, you get to keep that credit. Stock stays here, you keep the credit. Stock goes lower, but remains above 210. You get to keep that credit, and your break even, as I mentioned, over 8% below the current share price. So this might take advantage of that higher implied volatility while still giving you a directional bias.
All right, so that's your put vertical. Yeah. You are, managing risk with these trades. Yeah. You have another approach for trading Tesla as well.
Yeah, a little more risky on this one, but it takes your break even down even lower from the current share price in Tesla. A lot of people are scratching their heads right now with a lot of stocks, not only Tesla, but hey, where can I get in after these pullbacks, after 30, 40, 50% drawdowns from recent highs? And Tesla might be one of those. So if you have that in your back pocket where you're saying, oh, I wouldn't mind buying this stock if it even fell more, but I want to stay pretty conservative in the near term and give myself a big cushion to the downside for break even. So I looked at doing a back ratio here, a 1/2 put spread here, where I can take advantage of that higher implied volatility, give myself a big cushion to the downside. So going out to that same April 17th monthly options that expire in 8 days, avoiding earnings, we're going to buy a 1/2 here. We're going to buy one of the 215 strike puts, and then against that, we're going to sell 2 of the 210 strike puts. So this back ratio creates a credit of about $7.50, and that's what you get to keep if the stock remains above the 215 level. You just keep that big credit that you're collecting because of the higher implied volatility. Now, what does it take your break even down to where you start to lose money? That break even goes all the way down to 197.5. That's over 13% below the current share price. Now, because you bought one of the 215s, sold 2 of the 210 strike puts, you've got a short naked put there, right? That acts as a cash secured put. So if the stock does fall below 210 into expiration over the next 8 days, you're going to have to buy the shares. But look at where you're buying the shares. At that break even of 197.50, over 13% below the current share price. You see here on the risk profile, we got a little bit of a kicker right at or near that short strike at the 210 level, where we sold 2 options also. That's where you're going to get max profitability. So this is the same thing. You profit in 3 out of 4 scenarios on this one. Goes higher, you keep the credit. Goes a little bit lower, you get to keep that credit and you get the little bump. And if it stays here, you get to keep that credit. Now, the downside is it's riskier because you have to potentially buy the stock at that lower price entry point of 197.50 to the downside. So you got to keep that in mind. It's more capital intensive, but it's a much bigger cushion than the short put vertical.
And you're being fair. I mean, you're laying out what the risk is here, but what the win could be as well. Tom White, great to see you, and thanks for your focus on Tesla this morning.